You ever see a headline about some company getting bought for a crazy amount of money and just think, how? How do they decide that's the number? Well, today we're going to crack open that exact question. We're talking about business valuation, figuring out what a company is truly worth. And you're about to see, it's this amazing mix of hard science and, believe it or not, a little bit of art. Just look at this number, $21.8 billion. That is what Facebook, now Meta, paid for WhatsApp back in 2014. Now get this, at the time, WhatsApp had barely any revenue to speak of. So where in the world did a number that huge come from? That right there is the mystery we're diving into. Because here's the thing, what a company sells for, the price tag, isn't always the full story of what it's worth. That final price is just one piece of a much bigger puzzle. So let's get to the heart of it and ask the big question. What is a business really worth? To solve this, we've got to start with the single most important idea in all of valuation, and that's the difference between price and value. Yeah, I know they sound like the same thing, but in the world of finance, they are two totally different concepts. Think of it like this. Price is simply what you pay. It's the number on the sticker, the final handshake deal. It's all about supply and demand at that moment in time. But value? Value is the homework. It's the deep down intrinsic economic worth of that thing, figured out through a whole formal process. So one is a transaction, the other is an estimation. Big difference. And trust me, this isn't just some abstract concept for a finance class. This stuff matters everywhere. It's the absolute backbone of huge company mergers. It's what you do when you're analyzing a stock to invest in. Companies use it for their own strategic planning. It's even used in financial reporting and estate planning. Valuation is happening all around us all the time. So how do the experts actually figure out a company's value? Well, they don't just pull a number out of thin air. They basically look at a business through three different, let's call them lenses. Each one gives them a unique perspective on what the company's worth. Let's check them out. First up is the asset approach. This one's the most straightforward. Seriously, think of it like valuing a house based on the cost of its bricks, its timber, and the land it's sitting on. You just add up all the stuff the company owns, its assets, and then subtract everything it owes, its liabilities. It's a really tangible, what are the building blocks worth kind of view. Okay, our second lens is the income approach. Now this one is all about the future. Forget the bricks and mortar for a second. Here, you're valuing the business based on the cash you expect it to make down the road. It's like valuing an apartment building not on what it costs to build, but on all the future rent it's going to bring in. It answers the million-dollar question, how much money will this thing make? And our third and final lens is the market approach. You already know this one, I promise. It's the real estate agent's secret weapon. Comps. You figure out a company's value by looking at what similar companies have sold for recently. It's a reality check, right? It's grounded in what the market is actually willing to pay for something comparable. All right, so we have our three lenses: assets, income, and market. That's the theory. Now, let's make it real. Let's peek inside the toolkit for each of these and see a super simplified version of how they actually work. So here's the asset approach in action. It's a simple calculation called net asset value. For our ABC manufacturing, we take its total assets, 1.6 million, and subtract its liabilities, which are 650,000. That leaves us with a net asset value of 950,000. It's a solid baseline, right? But think about it. This number doesn't capture things you can't touch, like the company's brand reputation or its growth potential. Now, for the income approach, the most famous tool is called discounted cash flow, or DCF. The whole idea is simple. A dollar you get 5 years from now is worth less than a dollar in your pocket today. So first, you project the company's future cash flows. Then you pick a discount rate to account for risk and time. And finally, you do the math to see what all that future money is worth in today's dollars. And for our market approach, a super common tool is the price to earnings, or PE ratio. Look here. If we see that a similar business, company A, is valued at 39 times its annual profit and company B is at 45 times, we can make a pretty good guess for our target company. If its profit is, say, $1 million, its value is probably somewhere between 39 and 45 million. It's all relative. Okay, we've looked through all three lenses. We've used a tool from each kit. We have a value from the assets, a value from the future income, and a value from the market. But here's the catch. They are almost never the exact same number. So now what? How do we get to the final answer? And this brings us to the biggest takeaway of this whole thing. A professional valuation almost never spits out one single magic number. What it really does is produce a range of values, a floor and a ceiling. The asset value might be the lowest possible number, and the income or market approaches might give you the highest. The final price? That gets negotiated somewhere inside that defensible range. There's this quote from our source material that just nails it perfectly. The science is everything we just talked about, the models, the math, the data. But the art? That's the human judgment. It's choosing the right assumptions, deciding which approach to weigh more heavily, and of course, the skill of negotiating that final price. Which leaves us with one last, pretty fascinating question to think about. If all that math and science only gets you into a ballpark, what are the things that actually decide the final price? What pushes it to the top of the range or the bottom? Is it just pure negotiation skill? Is it a strategic need, like Facebook feeling they had to have WhatsApp? Or is it just being in the right place at the right time? That, my friends, is where the real art of the deal